Okay, cool. It looks like people are starting to pile in, but we'll kick it off. So, want to kick off, a panel series, right? Bring on, experts across the investing field, across a whole variety of asset classes. And today, I want to really cover an important topic in terms of investing in debt with a focus for cash flow. So, brought on, four fund managers who have all raised meaningful amounts of money. I'll each them to do their backgrounds. They've all focused across a whole variety of asset classes too. So, they have great perspective both in the debt space and also in the other asset classes space too, to have some perspective too. So Patrick, why don't you kick it off in terms of, your bio and background?
Okay. Well, background only, huh? Not getting all the way into the fire of the debt conversation yet. Well, I was an automation robotics guy, moonlighting investments, lost a lot along the way. Some of that was due to the debt. Made my way into real estate, energy, done some medical investments, some legal investments, really focus on non-correlated alternatives. And we do have a debt fund and financing funds. So talk about that today a little bit, but Passive Investing Mastery is a company and excited to be here.
Thanks. Cool. And Patrick puts on great educational content too in terms of all of his stuff. So definitely check it out. Yeah, Tate.
Yeah, my name is Tate Duryea, founder and CEO of a firm called Turbine Capital. We've a little over $100 million under management. We focus on commercial real estate, private debt, and energy. We've got a big oil and gas fund, very energy focused, but I'm a huge proponent of debt and excited to get into it today.
Cool. Yeah, thanks, Tate. What about you, Matt?
Well, I'm an economics guy. I got a degree in economics with an emphasis in accounting and CPA, living in Southern California. We've quit my CPA firm job in 2006 to go into real estate full time. And since then, we've flipped a little bit over 1,000 houses. We have lent out over 500 million to flippers in different markets around the country and have raised a little bit over 200 million for a lot of private equity investments and alternative investment strategies and things like that. Love the debt space as one allocation of an asset class that creates some good cash flow. So help a lot of people with the tax mitigation side of investing and some tax mitigation, strategies that are around real estate and non-real estate investments. So lots of fun.
Cool. Chris?
How's it going, guys? My name is Chris. I am the CFO of Nationwide Paving, and I have a lot of experience in both being the borrower on debt and also extending credit, and have a lot of experience operating and running highly levered balance sheets of different companies. So excited to be here and talk with y'all.
Cool. And Chris, why don't we stick with you too? Like, how do you think about how debt fits into a portfolio from the lens of the investor?
It's a great question. So when you talk about portfolio construction and you're looking at like the fundamentals of how you're going to put in the capital stack, I view it as a risk lens, right? And when you look at debt and you look at what types of debt, because there's not just one type of debt, there's multiple different types of debt. You really want to look at how does this debt affect the risk of the portfolio. I think a mistake a lot of people do is they'll jump in and they'll see that a levered, return is a better return, with less meaningful equity in the deal. And, I think that's great if it works out. But then if it doesn't work out, you can get upside down really, really quickly. So think you got to start with the risk, what risk you're incurring, and really understand when something goes bad, how am I going to make sure that this debt gets paid and that I can service it? When the economy changes on me, variable rate interest loans, we all saw it, I think that's the lens I look at through debt.
And Matt, what about you in terms of like your portfolio itself too? Like how does debt fit in?
So, it depends on the asset class, right? And what you're doing with that asset class. But, from a debt perspective, there's non-leveraged and leveraged investments that exactly what Chris is saying that, hey, they come with different levels of risk involved, right? On the hard money lending space, for example, you can leverage investments and leverage that debt, but it also can carry with it a significant amount of risk. I know companies out there that provide much higher in the teens returns for debt in the debt space, but they're leveraging it like 75% LTV on the debt aspect, which can get you into trouble, quite a bit. And, some of the professional lenders that I worked with that have 40 years seasoned experience, they're case is, hey, I don't want to do more than 30% leverage on my debt in a lot of ways, because when things go wrong and the market collapses, that's when you find out, what happens, how many foreclosures you're going to have. And, you really want to be very careful with your leverage. And especially, in real estate as a whole, I really try to limit my leverage ratios to weather that storm, because, for a while we've seen rent prices rise. We've seen, a lot of things change there over the long run. And as those things rise, everything's great. But when rents drop, when interest rates rise, and you see multifamily take a hit, from that arena, you've seen the fallout that can occur from that arena. And so being very careful with your leverage ratios and smart with it. And I even carry investments that have zero leverage on purpose to counterbalance other investments that have leverage, to be on the safe side, and put them in different buckets and utilize different leverage with different asset strategies. So I think being careful with your leverage ratios, especially when there's economic uncertainty out there and volatility that could be happening in the near future, I think being careful there is very important right now.
Cool. And then Tate, like what about you? Like, how do you guys use in your portfolio today too, in terms of on the oil and gas side, on the real estate side? Like, how do you all think about it?
Well, it's a very broad question. I think if we, on the oil and gas side, that's a non-leveraged investment. We do not utilize debt in our oil and gas fund. Obviously, we use debt to our advantage when we're investing in real estate. I think that's one of the beautiful things about real estate is the ability to leverage it. But if we focus on investing in debt products, I think that you'll find that the more sophisticated investor is, the higher their net worth, the more they love debt. And the reason for that is that they're not swinging for the fences anymore. They're not trying to get, a 2 or 3x equity multiple in 5 years. They're trying to protect their wealth. They're trying to protect their downside. They're trying not to lose money, and they're just looking for yield. And I think that when you look at the rise in the popularity of private credit, back in 2010, the private credit market in the United States was about $150 million, $150 billion. Today, it sits at about 2.3 trillion. So it has been, there's been a huge rise in the popularity of private credit funds, and for good reason. Bank lending is much more stringent today than it was 20 years ago. There's a large gap in the market in terms of lending products for, anything for businesses to builders to mezz debt and bridge debt products. And so I think that it's a great time to be a debt investor. You can earn very healthy, low double-digit returns while taking on very low risk with a lot of collateral. And so we can get into that, but that's sort of how I look at it in terms of how I construct my own personal portfolio when I'm investing. I tend to every year layer on more and more and more private debt positions in my portfolio as my net worth grows, because I'm going from more of an offensive position to more of a defensive position as my net worth grows.
Cool. And Patrick, what about yourself?
So, debt is not an asset class, and it's a legal construct. And it has more to do with your position in the capital stack, I guess. And kind of we're talking two different things. One is, are you using debt or are you investing in debt? And we do both. Right? We use debt in our acquisitions fund. Low leverage debt, like 65% is actually what our docs say, or lower, because gives us that cushion, right? Because as the equity investor, you're wondering how high you can go without losing it all. With the debt investor, like in our debt fund for commercial real estate, we're more interested about predictable cash flow and the security of the asset rather than the get rich quick. And that's the conversation I had with my wife when we started it. But the reason why I say it's not necessarily the asset class, because people think about debt as real estate, they think about mortgage. But the reality is, if the definition is a legal place on the capital stack, then we're issuing form of debt in our medical receivables fund to medical practices. It's not a loan, it's a financing agreement, but it's senior secured position, first position. Same thing in the legal industry. When we're financing attorneys, we're in a senior secured position. Now, we don't structure it as a loan or debt because we want more than principal and interest. And we can structure it through like a prepaid forward contract, which is something unique that gets capital gains instead of interest income. But those are all legally, and its construct, the security, the collateral is position similar to debt. And I think that that's what's really important, is to keep in mind that it's about really the structure, not necessarily am I a debt guy.
Sure. And wanting to dive a bit deeper there too, in terms of the actual underlying assets that you're investing into that operate in a debt-like offering for yourself to investors. Is that I think what we'll find here too is that between the four of you all invest in very different things as it relates to debt, right? Or debt-like offerings. So why don't you go a little bit deeper on what the actual underlying assets are that you're investing into and collateralizing with? Patrick, if you want to stay with you.
Okay, sure. What the underlying assets are? Well, litigation finance is one. Matt and I are actually working on some stuff there together, and it's going really well. And there are groups out there doing loans, notes to law firms, but we chose a little bit different path. It's essentially equivalent. We're doing a senior secured collateral, but you get a lien up against the law firm's assets, their corporate assets or their agreements, and you can take a first position across a broad amount. It's like kind of giving a portfolio loan to a real estate investor. You can get a portfolio loan to a law firm's pending settlements. And so that's a financing agreement. You wrap those all into a large fund and you've got a diversified portfolio with tens of millions of dollars in collateral and about, I think we're at 20-30% financed amount to that collateral. So low advance rates. Same thing in the medical industry. It's medical practices that are out there doing work, providing care, but getting paid later. And so we can finance against their receivables. The payers are like these large commercial insurance companies. Blue Cross Blue Shields are the best payers on the planet. And we can do 10, 20, 30, 50% financed amount to those legal contracts and get a return. So it's similar. It's the same thing in the real estate space. You know, a mortgage, typical senior secured position, first position mortgage investment, small balance commercial real estate fund. All of those have a little bit different profile on the returns, but all have the same position in capital stack with security, conservative advance rates as a normal debt product would.
Cool. And then Tate, I know on your end too, you're more on the pref equity side of the house or mezz debt too for real estate, right? Can you walk through what that looks like and why?
Yeah, we have a couple different products that we offer. One, our mainstay is our private credit fund. And so that's a big basket of preferred equity, mezz debt, and bridge debt positions that's diversified across a bunch of multifamily deals, industrial, medical office, a little bit of student housing. But you can think of that as, you know, a big carousel of shorter term debt positions with large equity cushions on top of them. What I mean by large equity cushion, you know, I think it's probably useful before we dig too much further into the complexities of these debt products to, in the interest of no one left behind in the audience here, that, you know, if you think about buying a house and you're thinking, I'm going to put 20% down and I'm going to get a loan for the other 80%, the bank is thinking, we'll give you a loan that's worth 80% of the value of the underlying collateral. So when you're thinking about investing in debt, you always want to put yourself in the shoes of the bank, right? Because the bank, if your house doubles in value, the bank does not participate in that upside. They just want their money back. And if the house goes down in value, they just want their money back. They don't care. They want their money back plus a return. And that's exactly how you should be thinking when you're investing in a debt product is, how do I make sure that I get my money back and I get my yield? Because you're exchanging the potential outsized returns or the upside for security and downside risk protection. How do you do that? It's by lending money in a secured position where the collateral that is securing your loan is worth more than the amount of money that you're putting up. So your worst case scenario should always be, I get paid back in full with my return. My best case scenario is they don't pay me back. I take back collateral that's worth more than what they owe me, and I actually end up making a better return than I would have, right? So our private credit fund is a basket of pref equity, mezz debt, and bridge debt positions across that are backed by real estate assets that have significant equity cushion above that, meaning that we would need to see about a 30 to 35% collapse in valuations from today for us to start taking a haircut. The collateral is worth at least 30 to 35% more than those debt positions. We also occasionally we just structured something called the Secured Income Fund. It's more of like a super CD where it's an 18-month in and out, almost like hard money loan, where we loaned a $5 million slug to a builder that needed to get a project out of the ground, and then he collateralized that both with a personal guarantee. He's worth just shy of $50 million, personal guarantee plus pledged Colorado property that he also owns that's worth about 5 times more than what we lent him. So ultra secure position. We're making an 18% return on that fund. We're passing 15% through to investors. Our investors are super happy. It's current pay. Investors are getting paid, 30 days after they invest, but it's more like a super CD. So we structure these types of things. The private credit fund is more of a long-term, 10-year plus fund, whereas the secured income fund is more of a short-term super CD. So we tend to structure things like that.
Cool. And Matt, why don't you cover more on the house flipping side? Right. I'm sure a lot of folks, when they think of lending, they think of hard money, right? Myself, I experienced there too. I think that's a great place to go start too. Like break down the logistics in terms of investing into hard money, both from the LP standpoint, maybe it's in a fund, and maybe also on the standpoint that you're doing yourself and lending direct to a flipper.
One of the things that I really focus on is pooling debt, where you have, debt across multiple borrowers, multiple assets. So you can really utilize that pooling effect to mitigate risk. And so at the end of the day, when you're going out and doing this, the number one rule of lending is to be happy whether they complete the contract and, pay you off, or you have to take the asset back. And even with headache, you're happy because you get to take it back and make money off of it. Now, that doesn't always happen, of course, but at the same time, you mitigate that risk through pooling investor capital. And we do this in the hard money space where we, have a fund where we don't use any leverage, underlying bank leverage on where we can utilize that against our actual loans, where our loans might be at 65 to 70% of the value of the after repaired asset. We hold back renovation funds and do construction draws on those. So we have major funds control along the process, but we also have a couple $1 million worth of income on a consistent basis with only $10,000 of expenses because we're not leveraging anything. So really highly profitable at the end of the day and low risk because we're diversified across 70 to 100 loans every single time on these different hard money loans. And we also go through and can sell off that debt where we don't have the risk ourselves, and we might sell off that debt to insurance companies and banks and still make a spread and an arbitrage on that debt without having the risk. And so not only do we have this diversified pool, but you can also sell off the debt and make a spread for your fund where you're not actually having to go through and use the leverage further like that, So those types of things are really, really key from a leverage standpoint. And in addition to that, we utilize some other strategies like accounts receivable financing where, the hard money fund might be at 65, 70% of the market value, but the receivables, there's thousands and thousands of these receivables that we're at 25% of the value of the receivables. And you look at historically and you see an 85% collection ratio on those receivables with like an average of a $6,000 balance. And so you're looking at some of those different aspects and different asset classes. And one of the things people don't talk about is what happens when something goes wrong? How do you take the asset back? In a hard money loan, it's easy. You go and you have a deed of trust, you go pull it back unless you're at a judicial foreclosure state and it takes you a year or two to foreclose on the thing, which you want to be careful about, right? And we've been burned in the past on that. But in receivables or other asset classes, you want to know that operational procedure of what happens if everything goes wrong and how do you protect yourself and your investors in that kind of a scenario. And so those are some of the things that are key. Now, you also use it as a massive tool. So many times we go buy a property, renovate it, tenant it, and get it fully renovated and financed on a 30-year fixed, and then bring in an investor or another homeowner and do an arbitrage with a land contract sale or some strategy like that, where we can make an interest rate arbitrage on that versus our sale. And you can also get down payments down and things like that to mitigate your risk in those scenarios too, where I might be able to finance at, a 6% rate or 6.5% rate, but I'm able to go and finance at a 7.5 or an 8% rate and make a spread there and a larger loan amount too. So not only are you making a spread, but you're making that spread on a different scenario. And so I'll give you an example that's really cool that I love. This one deal we did where I did a loan inside my 401k to a flipper where it was at 65% loan to value, and we did it at 14% flat rate, no points or anything like that. And then I sold off $450,000 of the $500,000 loan to one of my investors at an 8% rate. So I had 50 grand left in the deal and they had 450 grand left. And if you do the interest rate arbitrage on that, on my 50 grand left in the deal, I'm making a 68% return on my money. So that's how, now that's a 90% leverage ratio. I better be able to go pay off that $450,000 if something goes wrong, or be able to continue to make that payment and take over the collateral and go resell it again and make sure I'm okay there and have some buffer room to take care of that in case there's losses, right? You don't want to necessarily do that kind of leverage with your investors consistently where they're in that 10% scenario unless they really understand the risk. But how many times do I need to do that to really be risk-free? Do I need to last for 2 years like that before I have no risk and making a 68% return a year? It's exciting stuff, and the things CPAs get giddy about, I'll say, So the math gets exciting at those levels.
There you go. Really cool. And Chris, why don't you walk through a little bit of what you're working on the accounts receivable side too within the paving space?
Yeah, so I think everybody has kind of said the same, a lot of really great things here. But one of the things I would add is that you really have to understand the collateral that you're loaning against, right? And I think for you, Matt, like when you're loaning against a house, right? You understand the market, you understand, the comparable properties, you understand the nuances of whatever renovation needs to be done because
renovation, yeah,
50,000 times and you've been burned by it, I'm sure. And doing it yourself. So there's all the hard lessons learned. And so, one of the things that I think is the most important when you're investing as debt is the person that you're investing with. Do they actually understand the underlying asset? And do they understand not only what the collateral is and how to value it, but do they also understand the intricacies of offloading that collateral? What sort of market, when you are in a situation where you have to liquidate something, values tend to change. So there's a lot of those types of things that come back to just really understanding the market. And so for what we do on the financing side, where we finance receivables, we do it kind of in two different ways. But the thing that I like about the asphalt paving industry is that because you're putting asphalt on the ground, right, that receivable is inherently backed by a material that has been added to the property, which allows you to lien the property. And so similar to how, in a real estate deal where you're secured with a lien against the property, on the AR that we finance, we're also secured against the underlying asset, which is usually a physical property, and there's a lien. And it's really great because there's, like, when you talked about a judicial foreclosure, like I've been there on a couple real estate deals that I've loaned on, and it just sucks to be strung out for, a year trying to get your collateral back. And so one of the things that we really like about AR financing, particularly in the paving space, is that you can actually, there's a very established process for getting that owner to pay you. And oftentimes when you're doing the work for a tenant of a property that has, like a triple net lease with the owner. And underneath their triple net lease, they have to, they covenant that they're not going to allow for liens to go against the property. And so you have this situation where the person that owes you the money has the owner of the property coming at them, right? And then you also have their, the physical property as the collateral. And we really like that because we feel secure in it. But the reason why we feel so secure in it is because we understand the intricacies every single day of doing hundreds and hundreds of projects a year. We understand exactly what we need to do in order to secure the collateral, protect the collateral. We understand when, there's different macroeconomic factors going on where we're going to pull back on our leverage a little bit versus push our leverage up depending on the deal. And really it just comes down to familiarity with the asset and the underlying collateral.
And Chris, if you want to keep going too, like, how do you think investors have to go value and price risk in a deal? Because right on the debt side, I'm probably in 100 deals as an LP myself now. I've invested in debt myself really heavily, or debt-like offerings. And you see returns going from, say, 6% to maybe even low 20% too, depending on the deal itself. So if you're an LP and you're listening to this, or you're a fund manager listening to this too, and you're thinking about how do I go make sure I'm getting a fair return relative to the security and the risk I'm taking, how do you go evaluate what's fair and kind of what's market for the asset class, collateral, all those things do you have?
Yeah, that's a great question. The first thing that I do when I'm an LP in a deal is I evaluate and try to get a lot of deals on the table. So I'd look at a lot of different offerings and a lot of different funds. And a lot of times I'm comparing the actual offering to offering of the fund, and I'm getting down into the like nitty gritty of the PPM and understanding what underwriting processes are in place for the different operators. I kind of put, when I'm an LP, I put it into 4 different kind of categories where, number one, I'm going to underwrite the borrower. Like, are these people that when it gets hard, they're going to double down and figure out how to solve the problem? Or are these people that are just going to, kind of fair weathered fans and just, kind of run as soon as the going gets tough? Are they people that I personally feel comfortable with, that I trust, that I like, that I know? So that's kind of the first bucket when I'm evaluating a deal. The second bucket would be, do I understand, at least to a level of familiarity, that I can make an educated decision, what the underlying collateral is, what the dynamics are, and can I ask the questions to the operators of that fund? Hey, if this goes bad, can you walk me through what your process is for making sure the money's protected? I think it's just a collaboration as, before you write that check. And then I would say the third, really the third bucket is, I like to educate myself on the macroeconomic environment. Like, is this, what are the things that can shift within the economy that can affect the underlying collateral? And, oftentimes I'll spend a couple $100 to talk to somebody who's much smarter than I am around the particular, nuances of that. But that's typically how I approach like how I like kind of, I guess, a framework for underwriting where I place my money when I invest as an LP.
And Tate, I want to go back to you on this too. So I know you mentioned you've got more of, a structured finance or kind of, mezzanine debt for the developer you're working with, but also have a credit fund. Kind of walk through how you think about the differences in those 2 areas on 2 main points. So one, the return profile, whereas I believe the structure, the structured finance side's higher than the credit fund. But also 2, I want you to touch on like a reallocation for an investor, right? Because I know some deals in the space are evergreen, but that money keeps rolling and rolling and rolling, and they can be totally hands off. And some deals are more, hey, one off, we've got a scenario, go fund it, it's your opportunity, but it'll burn off after a period of time.
Yeah, great question, Sam. Thanks. So, 2 very different products, right? So if we start with the private credit fund, it's truly a debt fund. I mean, we've got some pref equity positions in there, which this is a little bit of a tangent, but most debt funds will throw off a 1099-INT. You're going to be taxed on that interest as ordinary income. The private credit fund is a little unique because of those pref equity positions. We can actually take advantage of some of the depreciation on the underlying real estate, and we can actually offset the about 11% return that our private credit fund makes, which is really nice. You get a K1 that has some losses, and you can offset some of that income, which is great. And that's more of a, like I call it a carousel, right? And for anybody who has heard some negative press in terms of private credit in the news lately, because there's been some runs on the bank and some redemption issues with some of the larger private credit funds. I was just at the FactRight conference in Scottsdale, Arizona, about a month or 2 ago, and there was a private credit panel, and all of these big money managers that have billions under management were kind of laughing about the headlines and going, these private credit funds are functioning exactly as designed. These are not money market accounts. So if you think of a private credit fund almost like a Ferris wheel. And if you get on a Ferris wheel, you know that you're going to go up and around, and you're going to have to go around a couple times until you can get off. And if you think of each one of those Ferris wheel cars as a loan, an outstanding loan, if we have $1 million that's in a deal, and everybody wants out, and that loan isn't set to mature for a couple of years, well, we can service some liquidity as one person's getting on the Ferris wheel and the other person's getting off the Ferris wheel. But if everybody wants off the Ferris wheel at the same time, it takes some time for that wheel to come around to let everyone off. So that's how credit funds work. That's why they're long-term vehicles. They're evergreen funds that go on for a decade plus. And there's constantly, we purposefully stagger the maturities of all of the loans within the basket so that we can either, if people want to be redeemed, we can service those liquidity requests, or we can reinvest those proceeds into the next loan. Before I get off the private credit fund, any clarifying questions on that? And then I can talk about more of those.
No, I mean, I think the private credit's a good conversation now too, because you've seen some negative headlines on it. And
right.
I think the issue you're speaking to is that, a lot of these private credit funds, you look at like the Blue Owls of the world too, is that most of their docs also say there's 5% liquidity every quarter. Right. And the issue you're talking about, the bank run piece of it, is a really important component. So understanding your legal docs,
not money market accounts.
Yeah. So like understanding your legal docs is so crucial, where if you are investing into a deal, it's say bar none important thing, understand if and when and how you have liquidity. Number one, in terms of what's legally allowed. But number two, does the underlying asset actually support that liquidity itself too? So if you want to keep going on that too.
Yeah, 100%. Like if you've got $100,000 in the private credit fund and you decide that you want out, and Sam, on the same day you're coming in with $100,000, we can do same day liquidity, right? Because Sam's coming in, you're going out, great. You high five as you're passing each other in the line, right? But if everybody wants off at the same time, that's what causes issues. And so it's not that these funds are broken. It's not that the underlying assets are not performing. It's that you can't get everyone off the ride at the same time. So I think that that's one of the most important things for investors to understand. Now, on the flip side, these are fantastic vehicles because, like you said, you can compound. I mean, we have a reinvestment option. You can either take the cash flow and turn cash into cash flow very simply, clip about an 11% return, or you can compound that. And when you look at the compound annual growth rate when you're reinvesting those dividends every quarter, you're up into the 13% range with zero volatility, with very low risk, and I mean, you're outperforming the S&P on the long-term average. So huge proponent of debt funds like that. I think more people need them in their portfolio.
Yeah, I agree. I mean, for me personally, I think I have about 38% of my total net worth in private debt and private credit from just where I'm at in my life personally. Absolutely. But Patrick, I know we got a good question in the chat here too, is like, how do you go evaluate a sponsor? I know for you, you're very, very thorough in terms of how you do your homework on evaluating who it is you're working with, what underlying asset you're working on too. So if you want to give us a whole, quick crash course on what you go look for on your end to see, does this deal make sense for my investors?
So, every investor is in a different place in life. Some of them are at cash flow, some of them are growth, some are at preservation, and they have different risk tolerances. Some people are interested in doubling and tripling their money every year, and they'll lose it all like I did in the subprime mortgage collapse, trying to do pre-development. So not everybody has been through some of those lessons, and some people just don't learn. But so I think I evaluate sponsors more so people that have learned. Just take a look at Lance Peterson, my partner in my debt fund, Dave Gooseman in my litigation finance, or Alex and Leon in my medical fund. All have been doing this for 15 years, their respective disciplines for 15 years. They've seen the ups and downs. They've seen Lance administered, I think, 200 debt funds at Verivest, $3 billion before he exited. Dave managed $500 million litigation finance funds for private equity groups, collected $20 billion, $300 million in medical receivables with Alex and Leon. I'm looking for people that have seen and been beaten and battered down like I have, and you've seen them climb out of it, but very calculated. A lot of people out there are thinking, equity is as high as you can go. I've been there, done that. Don't like it so much. Actually, one of the 4 funds we're operating right now is equity, and that's our acquisitions fund. The rest are private credit. And that's why it's because it's not really equity versus debt. It's debt versus well-written and underwritten debt. And that means a lot. You can lose big in even debt funds. I think looking at the, like right now, and it's about timing too. I think debt a few years ago was pretty boring. I mean, 6, 7, 8% in commercial real estate for those same assets right now. Like the numbers Tate's talking about, it's kind of what we're at. It's like we've been 14.2% monthly annualized distribution since inception for a 65% loan to value debt fund. Like that's extraordinary. And it has to do with being very conservative, finding the right kind of deals and investing with the right kind of people with the right relationships. I think that's been very strong. And I really liked what Tate said because, about the compounding effects and about the structure. Because, we look at, a lot of people think of debt like it is just an interest 1099 int. You're doing a note and that's all you get. But the reality is the world is much broader. Like in the medical finance practice, we have the income that's coming from a medical practice financing, collateralizing their receivables with, 40, 50% finance amount to that collateral value. That is passive income. It's not that passive income. Intelligent CPA, sometimes, not all of them are reasonable, but they can offset that passive income with other passive losses. So you're net even in a first position debt-like facility with the same kind of collateral and position. Whereas, as Tate was saying, if you're at a 14, 15% clip and you're compounding that monthly because you're deciding not to take the cash, that's like a 2x return in 5 years. Same kind of structures. Not all structures are created equal. If you were paying the clip on that taxes, you would be down 30% a year or more, depending upon your ordinary income level. That is a significant drain on your ability to win. And so I look for, like, my litigation finance guy goes, hey, look, we can do prepaid forward contracts. It's capital gains. It's not even ordinary income. Anyway, that's insane, right? How could you have senior secured position? You're getting a K1, but now it's coming back as capital gains. Mind blowing. I got $10 million of that coming back right now. It's pretty incredible. So if you work with the right kind of people that have been through it, they've seen the ebbs and flows, you see them crawl out of it. You see them come to the table with, hey, this is not only how you do it right, but this is how you structure it appropriately to keep your capital working with reinvestment structures and tax advantage methods. And they come back with a 15-year track record that it takes you 160 plus hours with an analyst, a couple months to even look at and review. Those are the kind of guys I like to work with.
There you go. I like it. And Matt, on your end, I think a big thing kind of looking at debt or credit in general is, can the receiver of that money in their business plan actually afford those payments and whatever it is you're doing, right? Like, is this money actual good money that's going towards them? How do you think about actually figuring that out on your end, right? When you're doing, say, hard money lending or working on more of a litigation or a receivables fund, like, how do you actually understand, is this good money that they're taking on to go build their business, profit, whatever it may be?
Yeah, I mean, really, first things first, after running a property management company and then lending $500 million to flippers, they're all liars until proven otherwise. So you want to be very careful with how much liquidity they really have and understand,
How do you verify that?
Yeah. So you're looking at not only bank statements, for example, on the hard money lending side, you're not just looking at bank statements, because the bank statements could be great. They could have reserves, but how much of that money is actually allocated to other projects that they have to make payments on? So understanding what other debt they have, understanding what their personal financial statement looks like, and other projects that allocation, that money is allocated for, is really important. And, honestly, a lot of times they will go through and we've had people modify their bank statements and lie about those things and completely try to commit fraud and that kind of stuff as well. But you're also looking at the cash flow of the overall investment, how much other cash flow they have going, what other deals they're doing, and things like that. You really want to deep dive further into the borrower, their experience level. If you have a flipper, for example, that's doing 10 flips a month consistently, do they have a bucket system set up and a reserve system set up for each one of those individual flips that they're doing? That's very key, because that means that if they don't, then they're robbing Peter to pay Paul. And if they run into overages on construction, do they have overage reserves on top of interest reserves set aside for those other projects that are in process? You want to really deep dive into that. And if they haven't done a few deals and taken a few punches in the face like Patrick was talking about, then they probably have not learned that lesson, and you really want to make sure that they have that experience. So deep diving, just like what Chris was saying about the deep diving of the borrower is the most important thing. And the second most important thing is the actual collateral involved in itself and what happens during that process. Now, some of the other aspects, like in the receivables financing, you're looking at how much that receivable pays every single month. And, what does that look like from a cash flow standpoint? And that asset in itself, is that cash flowing well enough? Even if they drive it into the ground, are you still okay, with that process? And are they still be able to make those payments based on current liquidity and capital reserves, their experience levels, as well as the asset in itself and what kind of cash flow that's producing? Because you don't want to rely on the operator. Something could happen to the operator. The operator could die on you. Like, we've had so many issues we've had operators that have gone through and put money down on acquisitions of hard money of single family homes to flip, and then just ghosted us after they put like 20% down on the project and just lost their money and walked away and were disappeared us, and, you realize it's the asset that's backing you. You want to look at the liquidity of the borrower and verify those things and deep dive. Before I work with Patrick, it took me like 6 months to really dive deep into these things and understand every aspect of this and how it's working. Because I'm not relying on Patrick and Dave for this aspect. I'm looking at what are these contracts, these litigation contracts before we start diving deep into that, and what's that asset look like, and how are they paying with the contracts with the law firms and things like that, so that I can see the law firms are the backup collateral involved here, and how is their ability to pay, not just, Patrick and Dave as key operators and business partners with me on that project. That's super important too, but you really want to verify multiple things here, not just one way, and making sure that you're deep diving into that person's situation, especially when you're, dealing with flippers and stuff like that, or and making sure they have sophistication enough to manage their money, which I found being a CPA, that's what burned me. I thought everybody was good at money because I was good with my money on bucketing things and putting them aside. And I learned my lessons too in the very beginning, learning, oh crap, I better go raise some money because I don't want to go through and have a problem here later on, and you realize you can get over your head very quickly, especially in the flipping space, when you have a marketing system going and you have to take that deal down if you get a good deal under contract. And so you better have the money there to be able to back you in that situation. So doing your homework on the borrower in depth and who that person is, but also the asset specifically, and is that thing producing? And if you had to take it over, how fast can you get that thing reproducing down the line? Because something can happen, like the judicial foreclosure state thing. We had a property that was $1 million of loan on a townhome package, and in a judicial foreclosure state, we had to foreclose on it. Our attorney, a year in, died on us, and we had to start the process over, and took another year of us making payments before we could actually take it over and finish the renovation and get that thing going. So we had to have the liquidity on our side to make sure our investors were paid no matter what, on that piece. Luckily, we had reserves and we put money aside for headaches just like that. And we had other cash flow streams that are helping supplement headaches over here as well. And so you're really looking at the whole picture, not just, that one particular deal.
Totally. Yeah. Really good points too. And, Chris too, why don't you cover on the receivable side, right? Like I know on your end, you're paying mid to high teens in terms of yield, right? Walk us through the actual business case of how that money itself is used, right? Kind of how the business itself justifies paying a return like that.
Yeah, so there's a kind of a term in finance called the net present value of money, and really the basic idea of it is that money today is more valuable than money in the future, and where you would look at that is like if you take an asphalt paving company, one of the things, there's some nuances in the industry that make it really difficult to actually grow these companies because of cash constraints. So when you have to go do a project, you have to have the equipment to do that project. Well, like asphalt equipment can be $1 million, $1.2 million for just one piece, right? And so you have all of these different constraints on the company trying to go out and complete this work. One of the things is that payroll runs every week for these guys. So when those guys are on the job and they're doing the work, the payroll runs every week. But then oftentimes they have to wait 90 to 120 days to get paid anything, even after the work has been completed. The other thing in asphalt is you have to buy materials up front and lay it immediately. So you're paying pretty much all of your job costs within, a week of completing the work. And then you're having to carry those costs for anywhere between 60 and 120 days. And so when you layer on the seasonality of that business, where most of the work gets done between April and October, it creates this situation where, these operators are left with a choice. It's either I grow slowly and I don't take as much market opportunity as I can to increase the value of my company, or I can sell my receivables for a 10%, 15%, 20% discount. And so that I can get that money in today and then continue to run and operate and grow. And, when you're an asphalt paving company and you're running, a lot of these guys can run 30, 45 30 to 45% margins, net margins on the project. Giving up 10% on that project in order to get all of that money today so you can go fund 6 or 8 more projects is worth it to them because they make more money over time. And so really their calculation is like, hey, I'm willing to take this discount in order to be able to advance and make more money in the future. And so that's really aligned. And then from like an investing perspective, where we're investing into that receivable, we really like it because we can verify that the job has been completed. We know, we have liens that enforce our rights to go and collect on that receivable. And it's really clear is the asphalt in the parking lot there or not? Right. It's not rocket science where, some other things that I've invested in on the debt side, it's actually really difficult to discern like what is what. I think about this on, on different sorts of more complex contracts that govern underlying assets. It's like, those can be really complex to understand, but in asphalt paving, it's very easy. Is it there? Is it not? Did the work get completed or did it not? And you can touch, see, feel, look at the underlying asset and see that the work was completed. And that's one of the reasons why we really like it on that side.
Cool. And we're going to open up to questions here as well too. So we've got 2 on litigation financing. So just more so kind of diving a little bit deeper into the mechanics of litigation financing. And as a subsequent question there too is, why do lawyers need loans? Don't they make about $500 an hour? So whoever wants to cover that one, feel free.
They only make $500 an hour. So imagine trying to help out somebody who doesn't have the funds to be able to support themselves. And we advanced financing to an attorney that has supported 1,800 military civilians and their families that drank contaminated water and have horrific illnesses or have passed as a result of that. They're not made of money, these people, but they need representation. What about the thousands of sexual assault victims that went to the LA Juvenile Detention Center, our children that were assaulted? Do their families have enough money to go up against LA County? They don't, right? So these attorneys are out there, and there was some evil deed done by some large government agency or corporation, and it's certainly not ambulance chasers. These are real issues that need to be solved, and it takes financiers to come and say, hey, look, Mr. Attorney, you've got $10 million in assets and in contracts that are in late staged or established law of fees that are coming to you. Look, we'll lend 20, 30% on that. That's it. We'll give you that. That'll help you get these across the finish line. Or attorneys saying, look, I've got 500, I got 1,000 individuals similarly harmed. If I can get another 500 or 1,000, I can give more meaningful settlements. I can make more money on my side, and you can participate as a lender. And so oftentimes they'll come and say, hey, look, we'll collateralize all your existing assets and we'll layer in, just like a lender would do us for a CapEx project. Hey, improve your roof. And here's enough money to start the roof project. Let's see how it's going. Let's add a little more. We'll tell the attorney something similar. Start bringing in more clients, bringing in more claimants, onboard them, see if we can underwrite the value of their claim. And as that goes up, we layer more out and we start building more collateral for them. Meanwhile, they get bigger and meaner and more intimidating to the big bad defendant, and the defendant wants to settle sooner.
There you go. Chris, this one's for you. So on the receivable side, are there some receivables that are better than others when looking at kind of credit profile?
In terms of what we look at of asphalt paving companies, like absolutely, there's much higher credit. One of the issues in the asphalt paving industry is that when you work for big box retailers, they will always pay you. They will just never pay you quickly. And so, if Walmart is 120 days outstanding on an invoice, you can call all you want. You're not going to get paid. They're going to pay you when they're ready to pay you, which they always pay, but it's just, when are you going to get those funds? And so, when you look at particularly that part of the underlying assets, it's like you have the credit worthiness of the customer that owes the paving company the money. And that really factors into how we underwrite the risk, right? If I'm underwriting, a guy who did 20 Walmart parking lots and has, a couple $1 million in receivables from Walmart, for me, that's going to be a much higher credit profile than if he did a bunch of, Tom and Sally diners from all these different ma and pa who you're not really, quite sure what their credit profile is. But there's ways that we can verify, especially if they're a publicly traded company, what we think their credit profile is, so that we can understand exactly how much we want to advance against that particular receivable.
And then a quick follow-up there too on the paving company. Why won't a bank give you a larger line of credit if business itself is growing? Is because sponsors don't want a PG debt?
No, it's not. It's not that you don't really want a PG debt. To be honest, the biggest thing the bank is going to look at is they're going to want to understand what the two things. One is your leverage ratios. So how levered is the company in relationship to the financing that you're taking on? And where paving companies sometimes struggle with that leverage is that when they go, all of their CapEx is generally financed. So when they go to buy a new paver, they're going to finance that paver. And so the leverage to a traditional bank, who wants to be at, in 40, 50, maybe 60% range, that's really just the value of the equipment for those guys. And so it is out there and a lot of guys can do it. But the other thing about an asphalt paving industry that I think is really important is that financial literacy is just about as low as it can get in any industry that I've seen. The average asphalt paving owner has less than a 10th grade education. And so when you look at the requirements of what a bank wants and when originating a loan, it's like they want, GAAP compliant financials. They want, personal financial statements. They want all of your bank records. They want all of these things that a lot of times the owner of the paving company is like, yeah, I'm just not even going to deal with it. I would rather just wait for my money than take the time to try to do all of the requests of the bank. And so I would say that's probably the number one reason why a lot of these guys don't go to traditional banks and are willing to just sell their receivables and move on past it.
Well, yeah, it's helpful. And then I say Tate or Matt, what is the best type of debt to be in, real estate or a different type of debt?
So I'm a huge proponent of real estate, but Matt, go ahead.
Look, real estate is great, except, if someone's defaulting in real estate, they're probably not doing a great job on the rehab. There's some other issues that can come up with that and some other risks that you want to be careful of and really know what you're doing on that side. I mean, I'm sure, Tate, you've seen the same thing across the board. And I don't know that there's a specific best type of debt. There is actually some great tax advantage strategies that you can utilize that Patrick was alluding to with regard to debt. Most of the time, debt is considered interest income that you receive off of that. And that's not passive income. That is portfolio income. So when you do big cost segregation deductions on your real estate portfolio and take it against only other passive income, typically, unless you're actively participate, then you usually can't take that against interest income. But a lot of times you can structure debt deals if you are in the business of lending as ordinary income. And so your investors now can be, or your LP investors that are passive are getting passive ordinary income. And now you can couple that with passive income, your real estate passive losses with your ordinary interest income that's really ordinary income now in that case. So you can structure debt in different ways to take advantage of the tax side of things. But I don't know if there's necessarily a, one type of debt that's better than others. You're really just looking at the collateral involved and saying, how do I take this back, right? And how do I mitigate risk?
I completely agree with you, Matt. I think, it's like saying what's better, single family homes or multifamily. It's like, well, you can find great deals in each one. It's like I think it's kind of the wrong question, right? It's what is backing it. It's almost like I'm agnostic to what's backing it, but you want to make sure that whatever is backing it is secure, that the value of whatever is backing your debt position is larger than the amount that the borrower owes you, and that you have a reasonable amount of recourse. If I was to, let's say I was a wealthy individual and Matt wanted to borrow $50 million from me against an apartment complex that he owned that was a $75 million apartment complex. And I don't know anything about multifamily. And I give him $50 million and he doesn't pay me. And I'm like, oh boy, I have to foreclose. I have to figure out how to foreclose on this thing. And then I have to figure out how to operate it, figure out how to sell it. It puts me in a bind, right? So, just because the collateral is sufficient, you need to think through what happens in a downside situation where you actually have to crawl into the driver's seat. Is the team that you're investing with capable of taking over the controls and actually landing that plane? Or are you capable of it if you're, let's say, making hard money loans and you actually have to go through that process of foreclosure and taking back the asset?
Can I answer it in a slightly different way? Because I love everything that I'm hearing.
Yes.
But essentially, I taking a step back. If you're going to invest, it's not, hey, am I going to invest in debt and real estate because it's good or worse? It's really about allocation. It's really allocation strategies. And we talk about constantly on our platform because we've posted 80 different now, completely different alt strategies, as well as, and we've had lots of people on this panel talking about different things. It's not about debt because that's not an asset class. It's not about necessarily should you be in real estate. It's about how much of your portfolio, your pie chart is going to go into different non-correlated markets. These are markets that don't rise and fall together. I was all in real estate and I lost everything. And I was in high tech and I rode that wave. And I saw my stock portfolio go up and down. The reality is you want to be in different kinds of investments that don't rise and fall together. And I call that spearfish, being from Hawaii here. Tate's not representing here, but I would love to see a little bit, but he's actually a little bit over this way. Right. But the reality is you got to take some time and you got to figure out, hey, what industries should I be in next? What fundamentals should I be invested in next? Because I don't want everything to go up and down with the dollar, with oil and gas, with gold, with interest rates. And so think about not is debt the next one? Of course, real estate is an allocation, but how do you structure an investment? Take a step out of where you're at in a completely different market with different fundamentals. How do you structure that to be secured, to have downside protection and buffer from volatility, and figure out the best way to serve a need in that industry, whether it's financing medical practices or law firms or paving companies or real estate operators, and build that pie chart so it has pillars of stability in it. That's kind of like how I like to take a step back and look at portfolio construction intentionally done.
Really good point. And we've got a bunch more good questions here too. So is there any way to exchange, right, via 1031 into a debt private credit offering at all? Maybe more for Matt.
That's a tough one. There's maybe if you're looking at, preferred equity positions and it's a form of debt, but you actually have ownership of the real estate to be able to go take that, and put it into debt. There's other strategies out there that you can utilize where maybe you do a 1031 exchange into another real estate, or, you go through and take that deal and maybe you sell it with seller installment sale to mitigate the taxes long term on that. But it's a rarity that I see. You have to do like kind for like kind. So real estate for real estate. You can't do real estate for debt typically, unless you're getting real creative, and I'd have to really see the situation to be able to, recommend to do that or not from a CPA perspective.
Assuming Tate was going to jump up and be like, oil and gas. It's like one of the very few ones that you can 1031 into.
Yeah. I mean, oil and gas is a very special asset class, right? Because we have some really unique tax advantages, unlike real estate where the losses are going to be passive. They're not going to be able to offset W-2. Oil and gas IDC losses can offset any type of income. So if you invest $100,000 in an oil and gas deal, you're going to get anywhere from, an $80,000 to $90,000 write-off for the current calendar year. I call this a lazy man's 1031. So you can take a highly appreciated asset, sell it, and then somewhere in the same calendar year, you're not actually doing an exchange. You're just recognizing the gain. And then at some point in the same calendar year, investing in something that generates losses, fresh losses. Obviously, we got 100% bonus depreciation back this year. So this works great in, you can do it with real estate. You can do it with mobile home parks and things like that. But Matt, you're the CPA here. You'd be able to speak better to in terms of recognizing a capital gain on an investment asset and then investing in another real estate asset that generates fresh losses. Those would offset each other, right?
It's much better situation sometimes because you're dealing with long-term capital gains at, a lower rate. And then you're able to go through and maybe do a cost segregation study on a new acquisition and not do a 1031 exchange, but be able to take those losses, in another way by your new acquisition and start over with a fresh basis.
and they offset each other. And then of course, oil and gas is, instead of getting a 40 or 50% write off in year one on your K1, which is kind of what we see typically in that multifamily space, you're seeing 80, 90% plus on an oil and gas deal. So extremely high passive, not passive, but active. They can be active losses in oil and gas, and they can actually offset W-2 income as well. So you can actually use them instead of going to chase down 20% gains on a real estate sale. They can go to chase down 37% active income, which is unique to the oil and gas space.
You can do, some instances, if you're a real estate professional that spends 750 hours a year and it's your primary income source, you can offset some of those depreciable losses against active income. Or in a short-term rental loophole type situation, if you spend 100 hours and actively participate, it turns it into a business, and you can do those types of losses as well against your active ordinary W-2 income. We just had a client that put down $300,000 on one of our short-term rental or super properties and basically got a $276,000 year one tax deduction for that type of strategy. So there is some
three
silver
bullets.
Yeah. Exactly.
Short-term rentals, rep status, or oil and gas. Those are the 3 silver bullets for the high-income W-2 people.
I think Matt's doing all of them right now, and that I saw the numbers on that short-term rental deal is just mind-blowing. It's incredible.
It's exciting stuff. Paying no taxes to the evil government, So
that's right.
There you go.
We're talking about here. There's no like one way to do things. There's a portfolio efficiency and a tax efficiency goal. But you don't want the tax tail to wag the dog. You don't want the depreciation to catch up with you and a recapture to hit you later because it's not gone. When I was an engineer and I was doing R&D credits, that was free money for me. I never had to pay that back. And then I got to real estate and I realized, oh, shoot, it's just an interest-free loan from the government that's coming back one day. So you really got to be wise. But I think it's more important, would you do the investment without the tax savings first? Would you do it without the tax savings first? And then portfolio construct, am I not over allocating in any particular one market dynamic? And then look at how to do it efficiently, whether it's pairing a passive income and medical with a mobile home park, passive loss, or it's structuring it in retirement efficient accounts and which one to do. And those are the fun Lego pieces that we all have to put together.
And I like that you're going right back to that foundational aspect, to the proper financial education, putting 12 months of your personal living expenses aside in reserves, making sure that you have your foundation set first, using debt to be able to cover your monthly expenses every single month, but doing other asset classes. We invest in debt, we invest in real estate, short-term, in multiple aspects of real estate and different strategies, different operators, different markets of the country, different asset classes. We invest in the, litigation receivables and things like that. I even own a cannabis farm. So there's so many different strategies that you can utilize to be able to create cash flow. And that diversification gives you the base so that you don't put all your eggs in one basket and you can weather the storm long term.
Cool. And let's handle a couple more questions too before we wrap it up. I know we're over time, so keep the hop. Chris, for you, on the paving side, on the job receivable, are you tied to a specific receivable, or is it more so a blanket across the entire portfolio itself too? And how do you think about the individual receivable versus the portfolio level risk?
Yeah, so when you're investing into it, you're at the portfolio level risk. And then what we're doing underneath the portfolio is we're actually purchasing the receivable, right? So we actually own the collateral and then have our rights to go enforce that with, whoever owes the money. So that's typically how we structure it. But there's a lot of risk if you're concentrated. And I think that, Matt, you were talking about this at the beginning of some of the benefits of being in a fund. It's like if you are just investing in one receivable, then all your eggs are in that basket. But if you're investing in 500 receivables and you're 1% of all of those, then now you have a much more stable and diversified risk profile. So that's typically how we do it is, you invest and then it gets split across a lot of different receivables.
Cool. And then on the medical side too, we had a few questions around the actual function, how the medical receivables work.
It's interesting I didn't know this until you know this, but anytime you want to access an industry that's, really steady, resilient, non-correlated, got to learn a lot about it and figure out how you're going to solve a need. Turns out these individuals it's called doctors that have been in school for half their life. I was an engineer. I would be upset if the payment terms were 60 days and 90 days was like Tesla and Johnson & Johnson, the worst payers on the planet. These insurance companies, they're telling these doctors, you're on the hook to give help, to give care, but we're going to pay you 90, 180 days, 2 or 3 years out. So they're banking. I mean, these otherwise healthy medical practices are cash strapped. And so they're looking at, as what Chris was talking about, thousands, hundreds, right, of receivables that take a long time. Some of them are short. Many of them are 2 to 3 years out. And they're saying, look, I wish I could invest in a new building, a piece of equipment, more staff, buy my own building, whatever it is. They have a real asset. They're not the payer. These AA credit worthy payers of the best payers on the planet are the payers. And so you can take those, collateralize them, and you value them like you value an apartment building. You say, look, okay, Mr. Business Owner, medical practice, let's look at your T12, your financials for the last year. Let's see not what you billed the insurance company, but let's see what you actually collected and when for what types of care and from what payers. And you can actually say, what is the collectible value of your receivables over that period? And you value them based on their past performance. And then you should put a conservative advance rate and you collateralize their entire receivables portfolio. So a handful of them here or there that don't pay out, doesn't matter. You got a huge cushion on that. Validity guarantees, personal guarantees, liens, and then you lockbox the payment so they don't even see it until you paid your return. That's a pretty awesome approach. And then to Chris's point, put it in a diversified fund. That's why my funds say diversified at the beginning, because you don't want any single point counterparty failure. Even though you're collecting from large payers, you could do it to a bunch of different medical practices across geographies and types of care. And now you have a large diversified pool of receivables that you could clip a pretty good return in a very stable industry from. Does that answer the question?
Yeah, and we actually have a follow-up too from the same person, Benji. So I assume it's different in how you evaluate different types of receivables. How would you evaluate medical receivable versus litigation versus real estate versus some other asset class too? Like, how do you think about, when looking at the return profile for given assets as they're likely slightly different?
It's actually remarkably similar because they all have a way to value. And in the legal funding side, in real estate, it's easy because you just hire an appraiser. On the legal funding side, our specific fund is late stage. We're not doing wildcat oil and gas drilling where it's speculative or the type of real estate investing I did when I lost it all, where it's pre-development. We're doing like the late stage cases where the settlements are already on their way, or it's established law, it's rinse and repeat. So you hire people that are very good at this, and or my partner, David Gooseman's doing it 15 years. And you can get a really solid look at what these receivables, what not necessarily receivables in medical and or claims are worth in legal. And then you just put really conservative advance rates on those. And it's very similar with skin in the game, operators with skin in the game, down payments. Since we're showing our dogs here. You got down payments, skin in the game, conservative advance rates and liens. It's all the same stuff.
And then I'd say, lastly, before we wrap up here too, when you look at verifying liquidity, right? How do you go do so? Because I know that's, pretty, it's not just like easy to go fake, but it's definitely, people get creative with how it is they show that. I know when you look at even working with a big lender like Fannie or Freddie, right? The PFS usually has some wiggle room, right? Less verified liquidity they really dig into. So on your end, right, for people who are verifying liquidity, how do you best do it to make sure it's at least mostly accurate?
From our side, we're looking at, like I said, bank statements and things like that, but also looking at what other liquidity they have in other companies and stuff like that. And you're also seeing what that money is earmarked for too. So, and how that works. And so really you're looking at the bank statements, you're looking at also financial statements and seeing, what has happened in the past with them and stuff too. And also you can put liquidity aside. You can actually make it so you don't have to verify that liquidity, where you can hold reserves yourself, like on the hard money loans and things like that, where you can put aside the renovation funds and interest hold funds and overage funds out of the construction draws up front beforehand, so that it minimizes the risk of them lying to you about liquidity issues and things like that, other than just the verifications on bank accounts and things like that.
Cool. Well, hey guys, thanks everyone for coming on too. We will link everyone in the notes here as well too, and the follow-up email, so you have all the post contact info as well. But guys, thanks for coming on.
Thanks for
Thank
having
you.
us. Yeah,
Thanks for having
great
us, Sam.
chat. Hey,
Yeah.
Matt and Chris.
Thanks, guys.
Thanks, everyone.